Software stocks, sink or swim, buy or sell. This is what we're covering today. Jessica Ramirez is my name, market strategist here with Moomoo. It's great to have your company as always. So where there's opportunity, someone else is usually experiencing pain. This is usually what happens in markets. And right now it's happening. Pain is intensifying in the software space. This is what we're covering today. We've seen some software stocks fall 20 to 50% from their highs. And this is basically forcing investors to really reassess whether traditional software as a service or SaaS businesses will survive, adapt, or slowly fade away in this new AI-driven world. Some are seeing these software bear market pullbacks in stocks as an opportunity. Others are worried that stocks in the sector could fall further. I personally think that software stocks will fall further. Some managers don't care. They're taking a contrarian view. They're trying not to pick the bottom. Instead, they're really focused on what some of these companies that we cover today, they're focused on what they could look like in 5 years from now. They're willing to ride out the volatility, ride out the bumps, ride out the waves, whatever you want to call it. They're willing to own some of these software businesses and believing that they could be leading the AI economy, believing that some of these companies will survive and they'll be needed more in the future, a lot more than they are currently. So this is what some are thinking. Now, in this process, some investment managers are stepping away, though, from software models that are at risk of being replaced or commoditized. So the real question is simple. Who is still relevant? Who will be in 5 years? And who is not? Who will be obsolete? Why software stocks are seriously being questioned right now is perhaps what some of you are wondering. Well, the software sell-off is not just about interest rates. It's not about sentiment, but it's about business models being under serious pressure, and that's because of AI. AI is now seriously replacing entire workflows. It's not just assisting them. So the market really woke up to this. The investment world did too when we saw the second wave of AI born. And this is basically where AI began replicating real SaaS functions from coding, design, analytics, reporting, customer support, you name it. So we saw this recently. Now, if companies no longer need to pay for software as much as they are now, as much as they will potentially in the future, obviously it's going to disrupt the entire SaaS ecosystem. This is the concern. And it's going to hit pricing power. It's going to hit profits. That's what we call margins. And it's going to affect long-term growth assumptions. This is the thinking, this is the concern, and these are the concerns in the investment world. And the damage right now, ladies and gents, it's pretty visible. Let's think about stocks in the US. So we've got Salesforce. As we said at the outset, some of these stocks are down well and truly. Let's have a look at Salesforce. Salesforce is down 40% from their 2024 highs. ServiceNow is down more than that, down 47%. Adobe, it's stinky, 54%. That's how much it's down since early 2024. Block, it's a doozy. I'm not even going to say how far it's down from its record all-time high because you can't even see that on the screen when you zoom out. But let's just talk about how much Block or XYZ is down from its 2024 high. Well, it's down 37%. And this is because AI is pressuring parts of these businesses' ecosystems. What about in Australia? Well, I'm glad you asked. Let's think about Xero, the accounting software. I guess you could say monopoly. Xero is down 50% from their 2025 peak. WiseTech Global down for a gamut of reasons, but one of those is on the back of what we're discussing today. WiseTech is down 56% from their record. That was hit in 2024. What about Technology One? Well, that's a little bit more resilient. That's down the least out of this bunch. It's down 38% from its high. So markets are no longer debating if AI is going to impact software. They're pricing in how much each of these business models will be impacted and if they'll survive. So what's next for software companies? You might be wondering that. Well, the clearest signal is perhaps what's coming from Amazon. Recently, we saw Amazon announce something huge. In case you missed it, this is what you need to know. So ahead of US tax season, we know that's basically kicking off, Amazon has come out. They're now going to sell their Intuit TurboTax. That's their software solution for the accounting service space. They're going to sell this at the lowest price ever in history. They've slashed costs 44%. Yeah, so it's a massive cut. So they've cut the price of this software down from about $80 to 45 US. This is basically not being led by innovation. It's not about growth. Amazon is clearly doing this because they are seeing serious price pressure because lots of people are increasingly turning to AI. So I think this is probably going to be a preview of what we are likely to see across the entire software space, not just in the US, also in Australia. So either software groups cut prices or they absorb profit margins from other area, or they're going to have to rebuild products, right? So this is something that you need to think about because otherwise AI will be replacing their businesses. So to regain investor confidence, software companies really need to show us that they are embedding AI into their workflows, that they are going to increase pricing power, and that they are capable of growing their earnings margins. We also need to see the third thing from companies, we need to see how they're actually leveraging AI to lower their costs now and in the future. Otherwise, they risk the investment world downgrading their future earnings. And as I always say, earnings growth and future earnings expectations drive the share price. So that's why we're saying you need to consider these things. Now, the second thing that you also need to consider is there's going to be a huge separation. And what I mean by that is companies most at risk are probably going to be, I guess, those companies where they're selling a solution that's based on bums on seats in a workforce. So we call that SaaS based or seat based SaaS. So these businesses are probably most at risk. They're also in part of these businesses that are most at risk. We typically see low switching costs and also, the businesses most under pressure are those that have got AI that is capable of replacing individual entire user functions. So, companies in this space, I guess we really need to see them step up, but companies more likely to survive and thrive are probably those that have got huge platform businesses. They own their workflows, they own the data, and they've got sticky customers. That's what you want to see because that will enable them to generate strong free cash flows. And you probably might want to see companies, heck, that have got proven abilities to reinvent their business models as well. So think about what we saw with Google as well earlier this year, and indeed 8 months ago, myself included. I said Google was not looking very good, and that's because Google search dived. But then no one knew that Google was quickly reinventing themselves. They employed or deployed millions, if not billions of dollars into integrating AI into their searchability. And then, heck, they went and launched TPUs. So the point of me highlighting this is that you need to see companies that are adaptable and that can pivot. Anyway, the point is, what are the big end of town doing? Fund managers. So they've not actually abandoned software. Sure, many have taken profits, they've selling out, but we are seeing a rotation underneath the surface. So capital is actually flowing slowly. It's going into dribs and drabs into Salesforce, Adobe, ServiceNow, Atlassian. And that's because AI is being embedded into their platforms rather than competing with AI. But down on the ASX, there is a bit of, a bit of question still up in the air. So focus still is on Technology One, WiseTech Global, and Xero. The key question is whether AI expands or compresses their long-term pricing power. We do know that Australian software is facing a lot more pressure because we are not really expecting any interest rate cuts, unlike the US. US software has also got tailwinds from Trump 2.0, benefiting from a likely potential rate cut and also deregulation. So that's why the market is thinking US software service providers might actually come out better here than Aussie ones. The common thread, investment managers, they are favouring platform software businesses with cash, strong margins, the ability to reinvest, and the ability to reinvent themselves and integrate AI pretty quick smart. So how do you actually find potential survivors yourself, ignoring everything that I've said? Well, earnings, remember, matters most. Earnings drives share price growth. So let's think about the underlying risks in software right now. Well, I'm just going to highlight the overall thinking of markets in the software and services space. In the S&P 500, the software and services earnings growth rate is now expected to drop from 19% in 2025 down to earnings growth of 14%. So you've got that adjustment, that compression or contraction in earnings growth. That's a concern, and the market seems to be adjusting for that. Down under in Australia, it's pretty bad. A very stark comparison. No earnings growth is expected this year. No earnings growth expected the year after. That is a concern. And that's why I'm saying you really need to be stock specific here because the market is going to wake up to this quick smart and not really expect a recovery anytime soon. But if you are patient and brave, note this, the market is actually expecting a very, very, very strong triple-digit earnings growth rebound in 2028 for these Aussie software companies. So that's something for you to consider. So before earnings growth explodes, once the dust has settled on the AI and software war, I think the survivors will become really clear who can survive the massive contraction. If you want to look at these companies yourself, there's a couple of course, key practical tools that you can use. One of those might be going to Moomoo. Just head to the Markets tab, then head to Heat Map, and then click on Software, and you can quickly see who are the leaders, who are the, I guess if you want to call them losers, who is a bit more resilient, or perhaps where is resilience emerging. Another way to actually skin this cat and to find companies is to look at software ETFs. This basically will show you where big institutions are investing via ETFs, and it will basically give you a ready-made list of stocks in a few categories. So, for example, you might want to look at the iShares Expanded Tech Software Sector ETF, ticker code IGV. It's basically will show you established cash generative leaders. It obviously includes the big heavyweights we all know, software giants like Microsoft, Palantir, Oracle, Salesforce, Intuit, and of course, Palo Alto, which we speak a lot about. It's a defense leader along with CrowdStrike. Another ETF to perhaps look at for inspo, the Spider S&P Software and Services ETF. This will give you pretty broad exposure to look at very different names in this software services space. So names that you may have never heard of, including Adaya, Daily Journal Corp, but it also includes companies like Accenture as well. So do have a look at that ETF. Last but not least, my personal favorite in the space is the CloudX Computing ETF. This, I guess, has got higher growth cloud and SaaS names, some of which you may have not heard of, but some are seeing, putting out really interesting products. Nevertheless, some of these companies in this ETF include Akami, DigitalOcean, Shopify, Zoom. Who on earth is using Zoom anymore? HubSpot, Snowflake, Salesforce, and Amazon. This ETF is obviously a bit higher risk if AI accelerates pricing compression. So keep your eye on that. The bottom line is we've given you so much to consider today. What you really need to consider is you really need to be selective when you are looking at markets and stocks, because as we said, not all markets are the same in the software category, right? So it's really critical that you think about that. This isn't about also picking a bottom. It's completely up to you what strategy you want to take, but it's probably thinking about being on the right side of disruption. AI will compress margins. AI will force consolidation. Some of these companies will sink, but the winners will be those with lots of cash, huge scale, and the ability to reinvent themselves, while the others will probably quietly fade away.